Good evening to all. Welcome to today's special lecture series program for undergraduate students organized by Kolkata Bidhannagar Society for Academic Advancement, coordinated by Azure Academic Services. Today, our guest faculty is CMA Deepashree Chatterjee ma'am. She is an assistant professor of commerce at Chandernagore College, West Bengal, India. With over 9 years of experience, she previously headed the Department of Commerce at Goenka College, a fellow member of ICMAI. She has corporate experience with PwC and holds multiple academic qualifications. She also contributed in multiple national and international level conferences and academic activities. Welcome, ma'am. Hello.
Thank you so much. Thanks for the invitation. I hope some of the students also have joined, and there might be many who are eagerly waiting for this session. So
Yes.
I'll just share my screen with everyone so that everyone can see, and then I will start my session. Yeah, I think my screen is visible to everyone.
Yes, ma'am, visible.
Okay. Okay. So in today's session, we would be understanding the basics of financial management. Absolutely the basics. So whenever we have the subject, we hear about the subject financial management, there are certain things that we expect and uh, we are supposed to know. So this session will take the students through this journey and help them understand the subject better, and students will be able to understand the entire thing, the basics. So I hope after this class, they will be enriched with several terminologies, and they will also be able to understand what this subject is all about and why this subject is so interesting. So let's get started. So we will be discussing today on the basics of financial management. I am Deepashree Chatterjee, Assistant Professor, Chandernagore College, Undergraduate of West Bengal. So as an introduction, let us understand first that what is financial management. At all is financial management. I hope everybody, students, my screen is visible to all of you.
Yes, ma'am, visible. Just
Okay.
hide the cap.
Yeah, sure. Yeah. So I hope my screen is visible. And in the meantime, if I can see some of my students have also joined. So in the meantime, if any one of you have any problem or any, like you cannot understand anything, you want me to repeat something or you have any query, absolutely feel free to ask, because I would like this session more of to be interactive rather than, like one-sided. Because if you have any query, the audiences across India or across the world who are sitting there, they might also have some query. So we'll first discuss what financial management is. What do you think if I ask you that what is financial management? What comes in your mind? Can anyone tell me what is financial management? What comes in your mind? Okay, so basically, financial management is management of finance. What finance? Finance is the lifeblood of the business. Funds, we all know, right? So, in simple terms, management of this finance is financial management. So it includes several other things also, like, whenever we talk of management, what does management includes? It is planning, organizing, controlling, monitoring. This is called management. So when we do all these things, that is planning, organizing, controlling, and monitoring of the financial activities of the company, it is known as financial management. So financial management practically is nothing but management of the overall funds or financials of the company. Now, whenever we think of financial management, there are certain important decisions that needs to be taken. So the main work of a financial manager or the chief financial officer is to take three major decisions on the basis of which the finance of the company depends on. Now, think yourself as the owner of a company. You have just opened a company, and you're going to start. You want to start any activity. Looking into the financial aspects, what do you think you need first? Finance you need first regarding the finance of the company. What do you think? First, we'll have to think of procuring the finance. That is, where from we get the finance. Now you are starting a company, पैसे के बिना तो कुछ भी start नहीं होगा. तो सबसे पहले हम लोग को देखना है कि what are the sources from which we can get finance. So the first decision that needs to be taken in financial management is called financing decision. So financing decision is what? Financing decision is the decision regarding deciding on the sources from which we will get the finance. So it is the decision on the sources from which we'll get the finance. Now we have procured lots of funds. I have lots of money with me. Now, what will I do with that money? I have started my own company. First question was, where will I get the funds from? So I have procured lots of money. Now I have sufficient amount with me. What will be my second decision? What will I do with the funds, right? The next question will be, so what this activity is called, what will I do with the fund? That means it refers to the investment of funds in different projects or proposal. Suppose I want to start a total business. So I will decide on where will I invest my fund, right? Or suppose I have two query, whether I can start e-auto business or e-rickshaw business, or I can go for hotel business, small restaurant business. So I have the fund with me. Now I have to decide which is the project in which I will invest my funds. So the second most important decision in financial management is investment decisions. So once I have got the funds, that is where from I will get the fund. This is called financing decision. And where will I invest the fund that I've already collected? That is called investment decision. Now, once I have invested, I might get, we are doing the entire thing for getting profit, right? So once I have taken the funds, once I have invested the funds, now I have gained profit also. Now I have to decide on that how will I distribute the profit, or whether at all I will distribute the whole profit, or whether I will distribute part of the profit. Because why profit is important? Profit, if can any one of you tell me, if the entire profit is distributed, then what will happen? Can any one of you tell me? Can any one of you unmute yourself and tell me that if the entire fund is distributed to the owners, what will happen? Can the business grow? Can the business grow quickly? Anyone? Can the business grow? No, the business cannot grow because if you do not invest, if you do not reinvest the money that you have gained as profit, then how will your business grow? So whenever we are earning profit, the profit has to have two components. The first component, which is being distributed to the owners as their reward for giving the finance. And the second part of the profit is something which is plowed back in the company, retained in the company for further growth of the company, right? So that part which is distributed to the owners or the providers of the fund, that is known as dividend. And that part of the fund which is not distributed to the people, that is known as retained earnings, right? So profit has two parts. One which is distributed, that is known as dividend, and the other one which is not distributed, that is known as the one which is not distributed, that is known as retained earning of drawing work of profits, right? So a company also has to decide on that whether it will completely distribute its profit or what percentage of profit it will distribute. There are different companies, there are some zero dividend policy companies also. Like we have some fast growing companies like Google and all. So Google doesn't believe on distributing dividend because the capital gain, because the retained earnings are high, and because of the retained earnings, the share price increases. And because of this increase in share price, the capital gain that people do is so high that they are not bothered about dividend. So there are some big companies, fast growing companies that have the policy of zero dividend, like Google. So there are some companies which mainly distribute dividend, which mainly plows back profit and doesn't believe in distributing dividend much. Then, do you have any query so far, students? Anyone having any query? Anyone having any queries so far? So I hope, yeah, okay, thank you so much. So I hope you are able to understand. Now, now coming to the first point, that is the financing decision. Now, what we will have to decide? We will have to take a decide on the sources of funds. Now, there are majorly two sources of funds. One is owned source and another one is loan source of funds, right? So think of that you have started your own business. So you can borrow funds majorly from two sources. If you have some savings, you will apply your own savings. If you still find some deficient, you will borrow it from others, right? So there are majorly two sources of funds. One is called the own source of funds, which comprises of mainly the shares and the profit which we are plowing back in the company, that is retained earning. And another part is when we are taking something on loan or debt. So that is called debt sources of funds. So what are the debt sources of funds? We may have debentures, we may have public borrowings, we may have bank loan, etc. etc. So we understood that there, whenever we think of deciding on the sources of funds, there are basically two sources. One, which the owner apna paisa laga raha hai, which is the sources of the owner's fund only, which maybe he has saved across his life or something. And the another one which he's taking from outside sources like bank, debentures from the public at large, etc. And anyone of like will understand that what is the difference between these two sources. So let us see that what are the features of these two sources of funds. The first is the owned sources of funds. So we will understand the features of the owned sources of funds, right? So whenever we talk of the owned sources of funds, the first thing is interest needs to be paid, right? Suppose we borrow funds from bank. Okay, tell me. Suppose we borrow funds from the bank. Anyone, students. So suppose my company is running at a loss. So can I tell the bank, see, my company is running at a loss, so I will not be able to pay you the interest? Can you say that? Can you say that?
না পে করতে হবে তো ইন্টারেস্ট
Yes, you will have to pay interest. So even if the company is running at a loss, you will have to pay them the interest, right? So in case of debt funds, interest needs to be paid irrespective of profit or loss. But when it is my fund only, so I don't have to pay interest to myself. So first thing is that no interest is required to be paid. So it's a big benefit for especially the newly launched companies, because they have chances of getting losses in the beginning years. So first thing is that no interest has to be paid. Second thing is that they get only profit, right? If there is no profit, they will not get anything. If there is profit, they will get it. And again, I said, remember that profit, all the profit belongs to the shareholders, right? That part of the profit which is distributed to the shareholders, that is called dividend, and that part of the profit which is plowed back in the company for further growth, that is called retained earnings. So what equity shareholders enjoy? They only enjoy the profit. They do not get any interest. Now, there are two types of shares we know. One is equity shares, another one is preference share. Now, it's very good, both are owners of the company. So it is very important for us to understand the difference between preference shares and equity shares. So let us understand what's the difference. See, whenever if you have seen any preference share, there that the dividend rate is mentioned. Like always, you will find preference shares in the form of 10% preference shares, 12% preference shares, 8% preference shares. What this percent before the word preference shares represent? This percent before the word preference share represents the fixed dividend that they are supposed to get if the company has profit. If and only if the company has profit, right? But if there is no profit, preference shareholders will not get any, right? So there can be two types of preference shares also. So we'll discuss about that. One is cumulative preference share, another one is non-cumulative preference shares. What does that mean? What does that mean? See, when you first thing that we understood is preference share get fixed percentage of dividend, right? Fixed percentage on what? On not the profit of the company, but on the face value of the share. Like suppose The value of each preference share is rupees 10. So how much dividend they will get? 10% of rupees 10, that is 1 per share, right? Irrespective of whatever is the profit, right? So suppose the company has earned a profit of 1 lakh and there are 1000 preference shares of rupees 10 each. That is 10,000 preference shares and they will get 10% dividend. So 10,000 ka 10% is 1,000. So out of 1 lakh, they will only get 1,000 profit. The rest 99,000 will go to whom? To the equity share. So the only difference, main difference between preference shares and equity shares is preference shares get a fixed rate of dividend, while equity shares, whatever is, and preference shareholders also get a preference over equity shares when it comes to getting the dividend. So profit का company का सबसे पहले किसको distribute होगा? First we will distribute to the preference shareholders and then after giving to the preference shareholders, whatever is left, that part of PAT or that part of profit will be distributed. All that belongs to the equity shareholders, right? First thing. So preference shareholders, number one, was the difference between preference and equity? Number one, preference shareholders get a fixed dividend irrespective of the amount of profit में. अगर company करोड़ में भी earn करती है profit, so in the example that I gave, the preference shareholders will still get a dividend of only 1,000 and not more than that, right? So first thing is preference shareholders get a fixed rate of dividend. Number two, preference shareholders get a preference over equity while distributing profits. So once we have arrived at profit after tax, first we will give the dividend to preference shareholders, and that is why the name preference. Preference means we are giving preference to the preference shareholders in distributing dividend. So our preference shareholders will get the dividend first, and then whatever is left, that belongs to the equity shareholders. Next is a very important thing is that equity shareholders obviously have unlimited profits because whatever is left, everything belongs to the equity shareholders. So there is no limit to their profit. Whether the profit is 1 lakh, whether the profit is 1 crore, or whether the profit is 10 crores. After giving only that 1,000, in our example, 1,000 to preference shareholders, the remaining entire thing would be enjoyed by our equity shareholders. Number one. Then, very important difference is equity shareholders, as you can see, equity shareholders are known as the real owners of the company. Now, what do you mean by real owners and false owners? Basically, preference shareholders, I don't say they are false owners, but equity shareholders are the real owners of the company. Why they are the real owners of the company? Because they have the voting power.
Rights.
Yes, very good. They have the voting rights. Excellent. So, voting rights regarding what? What do they vote for? What do they vote for?
কোম্পানিতে রানিং এর জন্য যে প্রয়োজন হয় ভোটে তার জন্য ভোট দিতে পারে।
Yes, for running the company.
Any major decisions.
Yeah, in any major decisions, basically they vote. They have voting power for selecting the board of directors. See, all of us can be owners of a company. In a public limited company, all of us can buy some shares, right? So when we are buying any share, we become the owners of the company, and they can be like lakhs and lakhs of owners like that. Can all of them participate? Can we participate in everyday life of the company or every decisions of the company? No. So for running the company, the shareholders select a few members who are actively involved in running the company, and they are known as the board of directors. So who are these board of directors? These board of directors are the people who run the company. The way our company is run by the government. See, all of us cannot run the country, right? So what do? We vote for selecting our government, and it is this government who make major decisions and run the company. Similarly, these equity shareholders vote for the board of directors, and it is the board of directors which run the company. Right? Now think logically also. Why equity shareholders have the voting power and why preference shareholders do not have? Because it is the equity shareholders who are actually concerned with the profit of the company. Preference shareholders, if they get the bare minimum profit, का share मिल गया, they are happy. अब company जितना भी profit करे, they are not going to get a single penny more, right? So they will not be affected much by the benefits of the company, by the profit of the company, as much as the equity shareholders will. That is why equity shareholders enjoy the voting power to vote the board of directors of the company. Look into our company. We Indians have the right to vote our government. Suppose there is a foreigner, right? So sitting in USA, he is not an Indian. Can we allow him to vote our government? No. Why? Because what will he do? He doesn't stay here. He doesn't decide here. Whatever is going to be bad thing or good thing in our company, he's not bothered about that because he's not going to be affected by that. So if he votes, the decision for selecting the government may be wrong. So that is why the preference shareholders also do not have the voting right because they only get a fixed share of dividend, and whatever the rest of the profit is distributed only to the equity shareholders. So preference shareholders do not have the voting right. Equity shareholders have the voting right in electing the board of directors who run the company. Right? So this is the main feature of own sources of funds. For what we understood, that own sources of funds consist of preference shareholders and equity shares. Preference shareholders enjoy fixed dividend, while equity shareholders, whatever profit is left after giving preference, entire thing is enjoyed by the equity shareholders. First thing. Second thing, equity preference shareholders get a preference over equity shareholders in distribution of dividend. Number two. Number three, equity shareholders are called the real owners of the company. Why? Because they have the voting power. They vote for who? They vote for the board of directors who will run the company. Right? So these are the three main things we learned about preference shares and equity shares and the difference between the two. Now let us come to the features of the debt sources, right? So equity sources or owner source, we understood equity and preference or retained earnings, and then we will come across the debt sources of funds, right? So in debt sources of funds, there can be numerous sources like loan from bank, like debentures, or like public borrowings, etc. So the features, let's understand that. The first feature is that the way owners enjoy dividend is that part of the or profit. Dividend is that profit which is distributed, and that part which is not distributed, plowed back into the company, is known as retained earnings. Remember that, right? So one more question I would like to ask regarding equity shareholders, that we know that preference shareholders only get dividends. So whatever the profit is, 10%, 8% committed profit is given to them, all distributed to them. So they get dividend. Complete the rest, entire profit is left for equity shareholders. Now, equity shareholders, some part is distributed, like say suppose 20% of the profits of equity shareholders are distributed. The rest is retained or plowed back in the company. Now tell me, we see this retained earnings we see in the form of reserves and surplus. So students, can any one of you tell me this reserve and surplus belong to? ये reserves and surplus किसका है? Preference shareholders का है या equity shareholders का है या दोनों का है? बोलो, can any one of you tell me? Who does?
Shareholder.
Excellent. Excellent. Why? Why? Because the entire profit belongs to the equity shareholders, right? So some part is distributed, which they already take home in the form of dividend, and that part which is not distributed but belongs to equity shareholders is plowed back in the company, and that is known as reserves and surplus. So obviously this reserves and surplus belongs to the equity shareholders. If at any point of time the company gets liquidated, who will take this reserves and surplus? The equity shareholders will take this reserves and surplus, right? And it is for this reason that you will always find the value of equity shareholders higher than the face value. So maybe I have purchased my equity share at the start at rupees 10. But now the value of equity shares like that of ITC or big companies TCS is more than 1,000. Why? Because they have plowed back and retained lots of profit across all these years, which belongs to the equity shareholders. So when I calculated what is the value of my equity, then it is not only the face value plus the value of that retained earnings divided by the number of equity shares. That is why the book value of equity shares keeps on increasing if there is profit in the company. So that is the reason the value of the company, if the retained earnings or reserves and surplus are present, is always higher than the face value. Right? Now, so coming to the debt sources of funds. So the first feature of the debt sources of funds is they enjoy interest, right? So interest has to be paid to the providers of debt capital, irrespective of whether there is profit or loss. So if I say that my company has earned a lot loss, I cannot, pay the interest. I cannot say that. So I have to pay interest irrespective of profit and loss. So that is why, if you remember the profit and loss account, profit before calculating the net profit, we debit the interest. So after deducting interest, we arrive at PAT, that is profit after tax, right? So from interest is a charge against profit, right? So what we learned that interest has to be paid irrespective of profit or loss, and that is why interest is a charge against profit. It is charged from the before arriving at profit. It is charged, and then we arrive at the. So it is debited first, and then the balancing figure is the profit that we arrive at. And obviously, the interest is always fixed. So in the way, like in all debentures, it is already mentioned, say suppose 10% debentures, 12% debentures, right? So what this 10%, 12% is? This 10%, 12% is nothing but the interest, the fixed interest that these debentures are on. So interest is always fixed in nature, right? So we learned that so features of debt sources of funds are they enjoy interest, which is a charge against profit. That means they have to be paid irrespective of profit and loss, and they are fixed in nature, which is written before the debentures or in the debt sources of funds are issued. So at the very time of the issue only, the debenture, the interest rate is fixed, right? Now, okay. Now tell me that I'll ask one question to all of them. You people tell me that suppose you are going to start a company, right? Now, which do you think where you will invest? Like where you will take the funds, your own savings or the savings of the owners, or you will borrow it from outside? Or think on the perspective of a company, right? So company will issue equity shares or preference shares more, और दे विल टेक लोन फंड्स में. क्या लगता है देखकर तुम लोग क्या करोगे? सपोज इट्स अ न्यू कंपनी दैट यू आर स्टार्टिंग, राइट? इंटरेस्ट फिक्स देना पड़ेगा अगर हम लोग लोन सोर्स ऑफ फंड से ले, और अगर इक्विटी सोर्सेज ऑफ फंड से ले तो वी डोंट हैव टू पे एनी इंटरेस्ट, वी ओनली हैव टू गिव प्रॉफिट. अगर प्रॉफिट हो, इफ देयर इज नो, वी विल नॉट हैव टू गिव एनीथिंग. तो व्हाट currently seems the best source, equity or equity source, that is owner source, or debt source? Tell me, students, what do you think? Any answer?
Equity sources.
Why equity sources? Why do you think equity source? Because you don't have to pay interest, right? Because you don't have to pay. Yes, because you don't have to pay interest, right? So equity source seems easier. Profit होगा तो देंगे, profit नहीं होगा तो कोई हानि तो नहीं होगा, loss तो नहीं पड़ेगा. At least ठीक है, होगा तो होगा, नहीं होगा तो कुछ नहीं देना पड़ेगा. So why? But we'll come across to know that it is not as easy a decision like that, and that is why we are learning this a separate subject called financial management. And all these decisions, that is financing decisions, investment decisions, dividend policy, we have separate elaborate chapters for this. So what is why is need of separate chapters? If it's so easy, no, it might seem that equity is the best, सबसे easy है, interest का झमेला नहीं है, profit होगा तो दो, नहीं profit होगा तो नहीं दो. So that is why let's prefer equity. It's not that simple. Why it is not that simple? Now we will be understanding, right? So first is why we can prefer equity. What is the reason why he said that? Yes, ma'am, obviously we'll go for equity. Mainly because no interest needs to be paid, right? So there is no fixed financial obligation. Even if the company has loss, I don't need to pay any interest. So I don't have any fixed obligation to pay anything. My losses will not increase, right? Most important reason why equity are preferred, right? And then why debt are preferred? Let us see that. Debt are preferred for many reasons, right? The first reason I will say is taking sources of funds or raising funds through debt. See, interest is a charge against profit, right? So when you pay interest, your profit gets reduced. And when profit gets reduced, you have to pay less tax on that. Because if the interest is not a charge against profit, your profits will increase. And suppose the company is paying 30% profit, then you will have to pay 30% extra profit if your profit increases by that amount, right? So whenever you are paying interest, you are somehow saving part of your tax. Why you are saving tax? Because your profits are reducing by the amount of interest that you are paying. So suppose you are paying an interest of 3,000 rupees. Let's take an example. Suppose you are paying an interest of 3,000 rupees and you have a tax rate of 30%. So if I wouldn't have paid this interest, my net profit would have increased by 3,000. So is 3,000 extra 30% tax? That is 3,000 into 30, 900 rupees. I would have paid to the government in the form of tax. Lekin, since I have paid 3,000 in the form of interest, my profit has reduced by 3,000, and so the amount of tax, that is rupees 900 rupees, which would have otherwise gone in the form of tax, I have saved that portion of tax. So if I find effectively how much interest I have paid, suppose 3,000 is the interest that I am paying and 30% is the tax rate. So I have saved 30% into 3,000, that is 900 rupees of tax because of reduction in profit, right? So if I now say that, okay, so I have paid 3,000 as interest. If I would have paid interest, my 900 rupees have anyway gone out of the company in the form of tax. 900 रुपया मुझे ऐसे ही देना पड़ता टैक्स, अगर हम 3,000 रुपीज का इंटरेस्ट नहीं पे करते, क्योंकि मेरा प्रॉफिट 3,000 रुपीज से बढ़ जाता, तो 3,000 का 30% मुझे, that is 900 rupees, मुझे टैक्स पे देना पड़ता. So that means that I have saved rupees 900 in the form of tax. So my effective interest that I'm paying is not rupees 3,000, but the effective interest that I'm paying is 3,000 minus that 900 that I have saved in the form of tax. So my effective interest is 3,000 minus rupees 900, that is rupees 2,100. This is very well represented in the form of a formula. That is, small I is equal to capital I into 1 minus t, where this small I is your effective interest rate and this capital I is your apparent interest rate, that is the visible interest rate that is there in front of all of us, and t is the tax rate. So let's say that you are paying 10% interest. Let's say you are paying 10% interest and 30% is the tax rate. So your effective interest now is not 10%. How much? Your effective interest represented by I think all of you can see my cursor. So the effective interest I is 10% to 1 represents 100% here. So 0.3 represents 30% here obviously. So 10% into 1 minus 0.3. 0.3 is the tax rate, 30%. So that is why it is 0.3, which is coming to 7%. So my apparent interest rate is 7% and not 10%, right? So is this clear to all of you students? Have all of you understood this? This part, this is very technical and it needs to be understood. मान लो 1,000 रुपए is my interest, 1,000 rupees is my interest, 30% is the tax rate. तो 1,000 के ऊपर 30% जो हमने बचाया 300 rupees. So that 300 rupees would have gone anyway. अगर हम interest नहीं लेते तो वो 300 rupees tax के फॉर्म में निकलता. तो मेरा effective interest कितना था? 1,000 minus that 300 that I would have paid in the form of tax. So 700 is my effective interest, right? In the form of percentage, it is capital I, that is the apparent interest rate, into 1 minus tax rate, which will tell you the effective interest rate. So we see that since interest leads to a savings in tax, interest results in a savings in tax, so the effective interest rate is always lesser than the apparent interest rate which we see or which we pay to the bank, right? From the perspective of the company. So is this point clear to everyone, student, or do you have any query? Is this point clear to everyone?
Yes,
Clear,
ma'am.
ma'am.
Okay, thank you so much. Okay. So now, so we see that one very important reason for preferring debt is it leads to a savings in tax and we have opportunity gain, right? And the effective interest rate is lesser than the apparent interest rate. What is the second reason for preferring debt? Very important, right? That presence of debt capital. Suppose there are, okay, tell me one thing. That suppose there are 10 students in my class, right? In my entire class, suppose there are 10 students. Then I will, and suppose 5 students out of them or all 10 students are saying, ma'am, please don't take class today. Let's give an example. Right? So all 10 students are saying, ma'am, please don't take class today. Or all 10 students are saying, ma'am, please take the chapter capital budgeting today. Right? So if I give an option, so I will listen to them, start the chapter capital budgeting. If there are 10, if 10 out of 10 students are saying, now, suppose if there are 100 students in the class and these 10 students only are saying, ma'am, let's start capital budgeting. All other students are saying otherwise. So, will I listen to these 10 students? Why? Because they are minority in number, right? So, we have only few, the power is concentrated around those. And if we have many, the power gets diluted. घर में जब एक ही बच्चा रहता है, वो उसका सब विशेष हम लोग फुलफिल करते हैं, जो बोले चलो पिज्जा ला दो, चलो ये ला दो, कोशिश करते हैं कीप हिम हैप्पी। अगर उसी घर में 10 बच्चे हो और एक बच्चा कुछ बोल रहा है, उस पर हम लोग उतना भाव नहीं देते, राइट? सेम वे में इफ देयर आर limited number of equity shareholders, their powers is concentrated. But if we issue a number of equity shares, then the number of equity shares will increase, the voting power will increase, and then voting power will be distributed to all of them, and so the power will be diluted among so many equity shares. So from the perspective of the owner, what would the owner like? The power to be concentrated to them or the power to be diluted? What do you think? What do you think, students? Tell me. So what would be preferred? The power of the equity shares as owners, what will I prefer? That power should be concentrated in my hand कि हम जो बोलेंगे वही सुना जाएगा और my vote will have lots of value. But the power be diluted कि मेरा वोट का कोई महत्व नहीं रहेगा क्योंकि सब में मेरा वोट डाइल्यूट हो गया. So what will an equity shareholder prefer? बोलो. Concentration of power or dilution of power? What do you think?
Concentration of power.
Excellent. Well done. Very good, students. So the equity shareholders would like the power to be concentrated in their hands, so that whatever they say, that is followed, right? Whoever they vote for, they get selected in the board of directors. Whatever they demand, that happens, right? So this can only be done if we raise funds through debt capital, because obviously providers of debt capital do not have the voting right. So whenever we take funds through debt capital, we prevent dilution of power. Next and very important thing on which we will do a practical problem and we'll understand this very important terminology. This is called presence of debt capital in the capital structure is something that facilitates or enables the equity shareholders to trade on equity. So this presence of debentures or debt capital facilitates trading on equity. Now, what this term trading on equity is, remember this is a very important term. Whenever you are going for interview as a financial manager, it's a very term on which you can be asked questions in the interview, or you can get there are high chances that you will get questions on what do you understand by trading on equity. It's a very common term, but very technical term as well. So we will be understanding what does the term trading on equity means. So whenever there is debt capital in the capital structure, equity shareholders enjoy something which is called trading on equity. What is trading on equity? Trading on equity is the scope of earning higher percentage of profit even with a small increase in EBIT because of the presence of debt capital in the capital structure. That means that if EBIT increases by say 10%, then the EPS, that is the percentage return to the equity shareholders, will increase more by 10% if debt capital is present in the capital structure. How? Let us understand that, right? So we will be understanding it through a practical problem which we will be doing together, right? So here I have a chart where, so we'll be solving together this same problem and we will be understanding the concept of trading on equity, right? Suppose there are proposals in front of us. Suppose a company needs rupees 1 lakh, right? And There are two proposals, proposal 1, proposal 2. Proposal 1, proposal 1, we have an all equity firm. There is no debt in the capital structure, right? So how we will raise that 1 lakh? 10,000 equity shares of rupees 10 each, let's suppose, right? So this is proposal 1. Then we have proposal 2. In proposal 2, what is our proposal? Our proposal says that let's do one thing. Let's take this 1 lakh, 50% from equity shares and 50% from debentures, right? So 50% from equity shares means 50,000 we have to raise. So let it be rupees 5,000 equity shares of rupees 10 each, which comes to rupees equal to rupees 50,000, right? 50,000 we are raising from equity. And remaining 50%, that is remaining 50,000, we are raising from debentures. So in the second problem, we have 510% debentures of rupees 100 each. So 500 debentures into rupees 100, again it is rupees 50,000. 500 into 100, right? It is rupees 50,000. So see, in proposal 1, we have raised the entire 1 lakh from equity, and in proposal 2, we have taken 50% from equity and 50% from debentures, right? Now let's see how this trading on equity works magically, right? Let's look at the first case, right? Let me insert a line here. Yeah. So let's see a first case where your EBIT. What is EBIT? EBIT is earning before interest and tax. So before we have paid interest, the earnings before interest and tax that we earn, right? So let this EBIT be 10,000, right? So we will be finding that what at this, right? Let's delete this. So we have 10,000 as EBIT. In proposal 2 also we have 10,000 as EBIT. Now, suppose, tell me that in the first case, are we paying any interest? Because it's an all equity firm. Do we have any debenture? Do we have any debt capital? No. So do we have to pay any interest? Students, please respond, right? So do we have to pay any interest? No. So what will be the interest here? 0. Interest will be 0 here. Now in proposal, what will be the interest? See, 50,000 we have raised from debentures, and what is the interest that we are paying? 10% interest. So what will be the interest here that we have to pay? 50,000 ka 10%. That means rupees 5,000. Okay. So let's do it like this. Equal to. Okay. Yes. So we have paid 0 interest here and we have paid this 5,000 interest here. So with this we arrive at something which is called EBT, that is earning before tax. After deducting interest, we arrive at something which is called EBT. So what do we get? EBT is here. Here the EBT remains as 10,000 and here the EBT comes as 5,000, right? Okay. Now tell me students, what we will deduct from here? From earning before tax. To arrive at earning after tax, what we will be deducting? Before tax, after tax. क्या minus जाएगा? बोलो.
Tax.
Excellent. Yes, tax. Very good. So we will be deducting tax here, right? Now we have seen that the tax rate is how much? 30%. 30% of profit. Now we have 10,000 here as the EBT. Here we have 5,000 as the EBT. So our tax rate will be this into 0.3, that is 30%. This comes as 3,000, right? So this, let me copy here. This will be also 5,000 ka 30%, that is 1,500 here, right? After deducting tax, we will arrive at something which is called earning after tax. So what will be the earning after tax here? 10,000 minus 3,000. This is equal to this minus this. So this will be 7,000. And how much will be this 1,000? 5,000 minus 1,500, which is 3,500, right? This is our earning after tax, right? Let's calculate the earning per share. So we don't have preference share here. So all the earning after tax will be distributed to whom? Equity shareholders. अगर preference share रहता तो हम लोग preference shareholder का part we would have deducted and then whatever was left that would have been distributed to the equity shareholders. लेकिन how EPS here is earning after tax divided by the number of equity shares. What is the EPS here? Tell me. 7,000 is the profit and how much is the equity share here? 10,000 is the equity share here, right? So what will be my EPS is equal to this divided by 10,000, because 10,000 is number of equity share here once again, right? Here we have 10,000 equity. So we have 10,000 equity share, we have 5,000 equity share here. Similarly, here also, proposal 1, we have 10,000 equity share. यहाँ पे 10,000 equity share in proposal 1, and in proposal 2 we have 5,000 equity shares, right? Okay. Now, what will be our EAT is equal to this divided by, equal to this, that is earning after tax divided by the number of equity shares. This will give me the EPS, earning per share, right? Here also we will have the same thing. This is earning after tax 3,500 divided by 5,000, that is 0.7. So you see that earning per share is same in both the cases, right? So equity shareholders will be happy, चलो ठीक है, हम 50% debt से ले या नहीं ले, मेरा earning per share तो same ही आ रहा है. So my earning per share is 0.7 in both the proposals. So I am indifferent that whether you are raising it from debentures or you are raising it completely to equity. I am indifferent from this aspect, right? From the aspect of earning only. Let's forget the dilution of power and voting power, everything. So from the perspective of earning, I'm indifferent because in both the cases, I'm earning 70 paisa per 10 rupees of equity share, right? Acha, let's see percentage return. Percentage return. How much percentage return is this? Percentage return here would be 0.07, that is per share, divided by what is the face value of per share? Rupees 10. So this will be into 100. This representative percentage, right? So we are representing the percentage. Percentage. So this is 7% return, and here also we will get the 7% return only. This is a chart in case of proposal 1, right? So you see here that in both the proposals, our earning is same, that is 7%. Now suppose the profit increases from 10,000, यहाँ पे 10,000 profit था, हमारा EBIT was 10,000. Now let's suppose the profit increases from, now the concept of trading on equity comes into being. So what do? From EBIT we subtract interest, we arrive at earning before tax. From earning before tax we deduct tax and we arrive at earning after tax, and this earning after tax is distributed among the all equity shares, all the equity shareholders that are present. So we find the earning per share. How? By this dividing the earning after tax divided by the number of equity shares, right? Equity shares. So we arrive at the earning per share, and then we found the percentage return. Now suppose the EBIT in the next year, it increases from 10,000 to, suppose there is 20% increase. So 10,000 का 20% increase कितना हो जाएगा? 12,000. So let it increase by 20%, right? So it increases by 20% and it becomes 12,000. Proposal 2 maybe 12,000 increases, right? So the increase is now from 10,000, the increase is 12,000. Now, students, I want all of you to answer, right? Please get up, because we want to find out what will be the interest here. But second proposal mein, when our profit increases, tell me, will our interest also increase in the same proposal? Our profit has increased, but will our interest increase as well? Yes or no?
No, ma'am.
No, because our capital structure is same, so interest will not increase, right? So यहाँ पे our profit has increased by 12,000, but the interest will be zero only here in proposal 1, and in proposal 2 the interest will be same, that is rupees 5,000 only. तो देखो अब क्या हो गया कि यहाँ पे increase is 20%, but this interest remains fixed, right? Now what will be our EBT? Let's copy the formula here. Same formula, and then we get so what is our EBT? This is minus this, right? 12,000. And this is coming as 12,000 minus 5,000, that is 7,000. This is our earning before tax. Now the tax rate is 30%. So what we'll do equal to this into 0.3, 30%. So we get here 3,600. And what will be the tax here? 7,000 to 30%, that is 2,100. This is the tax here. So what is the each here? Earning after tax is equal to our EBT minus tax. So we arrive at an EAT of 8,400. And here we are arriving at an EAT of 4,900, right? Now, what will be our EPS? EPS will be this EAT divided by the number of equity shares is equal to this EAT that we have arrived at, earning after tax, and this will be divided by the number of equity shareholders. See, number of equity share we have written here. So 10,000. And here, how much equity share we have? We have 4,900, which is our earning after tax. And with this, we will divide with 5,000 equity shares. We do not have 10,000 equity shares in proposal 2. We have only 5,000 equity shares in proposal 2. So we will divide it by the number of equity shares. See, what is our earning per share? In proposal 1, our earning per share has increased from 0.7 to 0.84. See, our profit has increased from 10,000 to 12,000, 20% increase in profit. So, but our earning per share has increased from 0.7 to 0.84, right? Which is more than 20%. Which is here 20%. 20% of 0.7 is 120% is 0.84. So here also the profit has increased by 24%. But in proposal 2, while the earning per share was 0.7, the earning per share has increased to 0.98. See, in proposal 1, it has increased to 0.84. In proposal, it has increased to 0.98, which is definitely more than 0.84. So, our profit has increased by 20. Now, let us find this increase. Let us find this increase, percentage return, right? So, what will be our percentage return? Equal to 8.4%. Yes, it will be 8.4%. Now, if we want to find the difference, what is the percentage return? How we will find it? This minus this divided by this. Let's see. This is 20%. And what is the percentage return here? Is equal to this minus this divided by this. What is the percentage return here? Oh my God, 40%. So you can see here that the percentage increase, right? So this is 7%. This is the earning per share, right? So the percentage increase in proposal 1, with 20% increase in profit, the equity shareholders return has also increased by 20%. But when debt capital was present in the capital structure, the percentage return increased by 40%, not by 20%. Why? Because the interest part here is fixed, right? And this is called trading on equity. Ki jitna zyada fixed capital, fixed interest bearing securities are present, the more is the earning per share and the more increase in percentage return per equity share. देखो यहाँ पे per equity shareholder return जैसे profit 10,000 से 12,000 increase हुआ, they are getting a return of 20%. 20% उन लोगों का return भी increase हुआ. 20% यहाँ से 10% से 10,000 से 12,000 is an increase of 20%. The return of equity shareholders have also increased by 20% in all equity funds. Lekin, when the EBIT has increased from 10,000 to 12,000 in case of proposal 2, where debt capital is present, then the percentage return has increased by more than 20%. How much it has increased by? It has increased by 40%. And you will find that more is the presence of equity share in the capital structure. मान लो, let's see. यहाँ पे अगर हम लोग इक्विटी शेयर को और हटा देते इस जगह में जहाँ पे 5,000 we have equity shares, if we further reduce the equity share, our percentage return will become even more high. Let's try. Suppose this equity share is, let's suppose you are reducing the equity share to 4,000. अब 5,000 नहीं रहा. Now the equity share is 4,000, right? Let's see. And this is also 4,000. Let's see. So see the entire. Now our debt capital will be now 60,000 here. So the interest will be 6,000 here, and the interest will be 6,000 here as well. So देखो जब हम लोग so interest will be 6,000 here, right? And then the entire calculation will change. Okay. We are not taking the this. Yes, now I put it because the formula was not there, right? So once you have the formula, then everything they will calculate it on this formula. Yes. Okay. So you see that whenever the more is the percentage return was 5, equity shares was 5,000. Now when I have decreased equity share, increased debt capital, then the return that was 20% that has increased to 50%. इसको अगर हम और घटा देते हैं और डेट कैपिटल और बढ़ा देते हैं, then this return will go from even higher. तो देखो हमारा profit has increased by 20%, but our return to the equity shareholders comes to 50%. Or it can be more if we increase the debt capital even more in the capital structure. So we have seen that lesser in the capital structure, the more is the scope of enjoying higher profit with every increase in EBIT. This feature is called trading on equity. This is a very interesting thing, very, very interesting. So what is trading on equity? Trading on equity says that if we have two way of raising finance, one in an all equity firm or another one where we have debentures also or debt capital also, then if the EBIT increases by any percentage, 10,000, say 12,000 or 14,000 or whatever, the return to the equity shareholders is higher compared to the percentage increase in EBIT if the debt capital is present in the capital structure. What is the logic behind that? The logic is the interest remains fixed. तो interest तो बढ़ा नहीं, तो जितना profit बढ़ा वो सारा का सारा equity shareholders में distribute हो रहा है. Our interest is not increasing, right? So the entire EBIT, increase in EBIT is distributed among the remaining equity shares, and obviously they are getting higher return. So this feature of increasing the return to the equity shareholders, even with a small percentage change in EBIT, the scope of getting a higher return. All equity firm at 20%, here they are getting 50%. If I further increase the debt capital, this percentage return will be even higher, right? So this scope of increasing higher percentage return per equity share because of the presence of debt capital in the capital structure is known as trading on equity. Is this concept clear to you, everyone? This is a very technical concept. Is this concept clear to all of you students? Any query? Is this concept clear to all of you students, or do you have any query?
ম্যাম পার্সেন্টেজ রিটার্নটা একবার বলবেন ফর্মুলাটা?
Percentage in this one, this you are saying, this formula, right? See, this formula, we want to see the percentage return. What is the percentage return? From 0.7%, 0.7, my earning per share has increased to 0.84, right? So what is the difference? See, this 0.84 minus 0.7 divided by 0.7, this will give me the percentage increase in earning per share, right? So we have applied this formula, 0.84 divided by minus 0.7 divided by the base, that is 0.7. So we can find the increase divided by 0.7. Kitna 0.7 ke upar kitna increase hua? This we have calculated, right? This we have calculated. And here how we have calculated? Same. 0.7 से 1.5 हो गया, right? So 1.5 minus 0.7 divided by 0.7. This will give me the percentage return, right? So this is the percentage return on EPS. And यहाँ पे percentage return, how did we calculate? 12,000 minus 10,000 by 10,000. This is 20% because has increased, we can do it by 5 cents, that is 12,000 minus 10,000. Suppose we want to find out the percentage continue increase in EBIT. So 12,000 minus 10,000 whole divided by 10,000 again. This will give me 0.2. 0.2 in the form of percentages, 20%. And see, our profit actually has increased from 10,000 to 12,000, which is 20% increase, right? So when our profit increases by 20%, our EBIT, our EPS also increases by 20% in all equity firm. But when our profit increases by 20% in debt capital present firm, then our percentage return in EPS in increasing not 30% but to 50% or more than 50% or more than 20% basically. तो जितना ज्यादा debt capital रहेगा उतना ज्यादा ये difference ज़्यादा रहेगा, उतना ज्यादा percentage return बढ़ जाएगा. So the lesser we have debt capital, the comparatively lesser will be the increase. Whenever debt capital is present, definitely it will be more than 20%. It may be 30%, it may be 40%, depending on what is the proportion of debt capital in the capital structure. Okay, so is it now clear, students? Okay, thank you so much. So this is a very important feature. Now you find out that all these things has to be taken care of while deciding what sources of funds we have to raise the funds from. So you see, it's not as easy as it seems. So whenever we are deciding on which source of funds to take, we have to take care of all these things. No? That first, equity shareholders, we don't have to pay interest. Debenture shareholders, we have to pay interest, but it is cheaper because it results in a savings in tax, number one. Number two is it allows concentration of power and prevents dilution of power. And number three, and most important thing, it leads to trading on equity, which we have understood so far. So you can understand that financing decision, now the company has to decide on what should be the ideal proportion between equity and debt capital, so that the cost of capital to the company is minimum and the return to the equity shareholders is maximum. So you see that this is not as easy as it seems. That is why we have a separate chapter called cost of capital, where we learn all these things and what is the ideal capital structure of a company. So in capital structure decisions, we do that. Then now when we have raised the funds, the next decision is investment of funds, right? So for this, we have a chapter called capital budgeting, where we have different methods like NPV, IRR, profitability index, payback period. There are different methods which you will study in details in the chapter capital budgeting, where you study the investment decision. So we have different projects, which project to opt for. This decision is also important, which we will study in details in the chapter capital budgeting. And finally, the profit we have earned, how much we will distribute and how much we will plow back. Because depending on this, the market share of the market price of the shares will also increase and decrease accordingly. So what proportion of profit we are distributing, that will affect the market price of the share, right? So all these things are not that easy. That is why we have a separate chapter called dividend policy, where you will study how much dividend should be distributed, right? So this is all about the basics of our financial management. So what we have studied, just a gist and just a recapitulation, we have understood what is financial management, which is the management of finance basically. Now financial management involves three major decisions regarding financing, that is sources of funds, decision regarding investment, once we have taken the funds, where we will invest, and the third decision is how we will distribute the dividend, that is the profit that we have earned. These are the three main decisions that are required in management, in financial management. Then coming to the first decision, that is deciding on the sources of funds. See, apparently it seems that equity shareholders is the best, raising funds through owners is the best, क्योंकि कोई interest का झमेला नहीं रहेगा. But it is not that easy, because we have seen that while owners have their own benefit, that we do not have to pay interest, but taking funds from owners reduces their earning because there is no scope for trading on equity. Number two, that power get diluted because equity, if there are more of equity shareholders, then the power of each equity share will get diluted among so many, which equity shareholders would never like, right? And third thing we understood, that raising funds through debentures leads to a savings in tax. So our effective interest rate to the company is always lesser than the apparent interest rate that is there. So all these things have to be taken into mind whenever we are deciding that what should be the ideal capital structure, that is what should be the ideal proportion of the debt sources of funds and the owner's sources of funds, right? So this, all these things we will study in the chapter cost of capital and capital structure. Then where we will invest the funds that we have raised, all these things we will study in the chapter capital budgeting, and how we will distribute the dividend. All these things we will study in the chapter dividends, right? So this was all from my side regarding the introduction to financial management. This is an excellent paper, and if you study it thoroughly, you will love all the technicalities of this paper. So I hope everything is clear to you. Is there, do you have any query, or would you like to have asked anything, or is it very clear to all of you? I hope whatever I have taught or whatever we have discussed today, this is clear to all of you, right? If you have any query, you can ask me. Do any one of you have any query that I could not acknowledge so far? Okay. So that's all from my side. Thank you so much, students.
Thank you.
Thank you so much.
Thank you so much, ma'am, for your lucid explanation on the basic financial management. I don't think there is any doubt left among students after your detailed explanation on the all the calculations and all the theoretical part. And this was really engaging and energetic session. Thank you so much, ma'am. And I hope we will get more lectures in the upcoming future. Thank you so much, ma'am, once again for bearing time with us out of your busy schedule. Thank you so much, ma'am.
Thank you so much, everyone. That's all from my side today. I hope that we could be doing even more lessons in future, and that will be more interactive, and that will be more enriching for you as well. So don't I'm sure all of you are not scared of financial management, and I have been able to generate even 1% more interest towards this subject after this session. So thank you so much, students. Thank you.
Thank you so much, ma'am. We are concluding today's session.